I've noticed that typically most traders will have their stop losses too close to entry, and they will give their trades too much room when exiting.
Two traders, Darren and Walter, pull back the curtain on profitable trading systems, consistent money management, and profitable psychological triggers. Welcome to the Two Traders podcast.
Welcome back to Two Traders. It's Walter here. I've got Darren on the line. Hello, Darren.
Evening, Walter.
So we're going to talk about how natural is trading, or why is it? I guess the question is, why is it if the market only goes up or down that you can't just flip a coin or throw a dart or watch a squid? Have you seen those things where they have the squid?
I have, yeah.
And the squid chooses, which team is gonna win the World Cup and things like that. Have you seen that?
I have, yeah.
There's like this famous, the famous squid, right? I forget his name.
Was it a squid or was it an octopus? I think it was an octopus.
Maybe the octopus. Yeah, octopus. I've got squid on the brain. My friend just went squid fishing and he was telling me about it. I think that's why I've got squid on the brain. But so this octopus was really accurate. So the question is, why can't we do that with trading? Why is it that's like some traders will say, look, it can't be that difficult. It's either going to go up or it's going to go down. How come every time I take a trade, it seems like I'm on the wrong side? Why is that? Is there something about the markets that makes that more likely, Darren? Is that? I guess that's my question, because I've been thinking a lot about this. And I think you can use this principle, and others also agree. But what do you think about this? Why is it that it seems like it should be so easy to pick a side, and yet oftentimes the way that it works out for us is, especially in the beginning when you first start trading, it's almost like you should just reverse every decision you make.
Yeah. Difficult one to decipher, really. I think you can just flip a coin and and pick the direction from that. I think it's the other elements that are important, and maybe it's the fact that we are looking for something to go instantly in our direction that leads to all of the other mistakes, which eventually means, like you say, it feels like you're never winning, such as having the stop too tight, moving the stop to break even too quickly, and then closing out your winners before they reach their target. I think those simple things creep in because price doesn't necessarily always go in your direction. But I think really the problem lies in the ones that do go your way being affected by the fact that so many are not. And I think that, also there's this idea that somehow your system and your analysis is going to time the turn in the market. And when you sort of break it down and think about it, what a ridiculous thing to say, really. If you think about the complexity of the orders coming in and out of the market, you might be looking for the close of this 1 hour bar, but to presume that everybody else is working on that basis as well, with so many participants, it just seems a little bit, far-fetched for me. And so I think, we have this obsession with being able to time the turning point. Really, that's what most people are looking for. They want to get within, however many pips, not too many, of the point where a price completely turned around. And we kind of hang our hats on these kind of simple things as basically telling us what the whole of the other market is thinking and doing. And, really, that's ridiculous. So you're not ever going to get that right. And if that's the case, then you've got to look for your edge in something else. And, it can be as simple as letting trades run. I just think we're looking in the wrong places.
Right. Yeah. So like a simple solution is, instead of trying to be right, you just, when you're right, maximize it, let your trade run, something like that.
I think that's closer to it. I can't just sit here and say, look, okay, hold everything for 5-to-1 risk to reward, and that's it. Nothing else matters. I'm not gonna say that, but I think that sort of approach will have a greater effect on your results than focusing on trying to time the entry.
Yeah, and I think kind of the assumption in the question, which is, why is it if the market only goes up or down, I seem to always be on the wrong side? Shouldn't I be able to flip a coin and figure this out and make it work, and be right half the time? The assumption there is really tied to the question, which is it's all about the entry. I've got to know when, which way to go. Like that's kind of what the question assumes, is that trading is about making this work, making profits, is about finding the right entry. And that may not be right. I've found it fascinating to watch the open position ratios, and I'll link this up in the show notes for people that are interested or haven't seen it. But I use it. I use it as an additional tool for my trades, where I look and say, well, what are the retail traders doing? Well, every 20 minutes I can get these data, and it says, this is how many for this broker. And a lot of brokers will offer this information. It's not always updated every 20 minutes. It might be daily or something. But what you can see is, what are all the traders doing? And the reason why I want to know this is because I want to know, where are the really tiny pockets of traders trading? And then I'll pull up that chart and say, okay, yeah, that makes a lot of sense to me. So for example, as we're recording this, and I'll post the chart in the show notes so you guys can see, but as we're recording this, I have what I would consider to be a very bearish pattern on the Euro Swiss. Okay. Now, when I go and look and see what right now, as I'm looking at the numbers, it says that 70.6% of the traders who are trading the Euro Swiss at this broker are buying. And I've got a pending sell order. So what I want to happen is I want to be in that little group of 29% or 25% or whatever it is of traders who are going the other way. And what I find fascinating is if you watch these numbers, so let's say, for example, the market's trending. A lot of times what you'll see is, if the market's starting to go in a trend, you'll see a lot of people trying to take it the other way. So if it's just starting to go on a bullish trend, traders will be looking to sell. And what happens and what kind of fuels that trend, my belief, is that the market is just going up there and reaching all those orders, all those stop losses that are up there for the market, for the traders who are going against the trend. And it keeps clicking into those and it keeps fueling the trend. At least in the beginning, that's really, really obvious when you look at these numbers. The other thing is that, like, if they're right, so if the crowd is right, as soon as the market starts going in their favor, the numbers completely reverse. In other words, everyone's getting out of their trades really quickly. Yeah. You know what I mean? Like, it's totally obvious. Like, it's the funniest thing, but you can see it on this. So I think it's just I think it's something that every trader should at least once have a look at and say, okay, what's going on here?
Yeah, I mean, even if you don't want to use it to trade, it's telling you the realities of the movement of price and how the majority of traders who are losing are playing it wrong. Getting out of their winners too soon. Yeah,
actually, both of my trade, 2 out of the 4 trades I'm in right now. The other one, the only reason the other ones aren't on this list is because they're like exotics or whatever. They don't actually follow the percentages. But so I've got, or not, my Euro Swiss trade hasn't been triggered, but I've got the order in. I've got another trade on the Aussie where I'm buying the Aussie, and 64.6% of the traders are selling the Aussie right now. So that's kind of like you might not use it by itself, but it's kind of like, okay, I feel good knowing that there's a lot of, hopefully, that traders are using stop losses, and hopefully those stop losses are fueling this move. That's kind of my my thinking here. So, but I guess the reason why I bring this up is because it kind of highlights what we're talking about here, where it's difficult for, like, it seems like traders, when they see the market go strong in one direction, most traders don't think, and I've tested a lot of traders, and I've found this to be true, that about 70-80% of the traders, when the market goes really strong in one direction, they're thinking, okay, I want to catch the reversal. Where's the reversal? Where's the reversal? I got to get this reversal. That's what they're thinking. They're not thinking, okay, I want to ride this trend. I want to ride this trend. That's the minority that thinks that. So I find that pretty interesting too.
Yeah, because it always appears like those trades come back and they do retrace, and this is the whole point. You have to have some sort of process for allowing your winning trades to come back a bit and let them move on again. It moves in that up and down movement, and People want to enter a trade and they want it to go straight from point A to point B. And it just never does that. You might get one crazy spike in a blue moon, but generally it's going to meander, it's going to, spike up towards it, and then it's going to retrace back, and then it's going to start climbing again. And you have to kind of go through this whole process. And I think traders just have, not traders, people have difficulty with that. They have difficulty seeing it through.
Yeah, absolutely. So if I'm thinking about what you just said in terms of the chart and the numbers and the open positions, I would say, all right, let's say, for example, everyone is thinking that the pound's going to turn around. Okay, and the pound's going really up, really strong, let's say. So the pound's moving up. It looks like it's an uptrend if you look at the chart. And you look at the numbers, and 77% of the traders are shorting the pound. Okay, so there's a really small 23% minority that's going long, is going with the trend. So now, if you watch the numbers, what would typically happen is as soon as it starts to retrace a bit, right, a lot of those traders will stop shorting the pound or close their positions. In other words, they're capturing these little retracement moves that you're talking about in the midst of a trend. So they're taking a bite out of the little slice of the pie, right? Whereas the minority, the trend traders, they're trying to take a bite out of the huge piece, the rest of the pie, so it's an easier thing to do in terms of the numbers, but psychologically it's difficult to look at something and go, well, it's made a 51 week high, the pound's higher than it's been the last 51 weeks. So yeah, I think it's going to go further. Like that's psychologically, I think for a lot of people difficult to do that. And that kind of gets back to our original question, which is why is this so difficult? Why does it seem like every decision I make as a trader is the wrong one? Why is it that I feel like I know that it can only go up or down, but I keep choosing the wrong side? The other thing I will mention, because I've noticed this too, and I think you might agree as well because the way you trade, I've noticed that typically most traders will have their stop losses too close to entry, and they will give their trades too much room when exiting. So if you think about it, you get into a trade and let's say you had some sort of trailing exit to get out. Typically what happens is traders will want to have a really, really tight stop on entry, and they'll want to give it a lot of room on the exit. So they're more likely to get stopped out on the entry, and they're more likely to give back too much on the exit because their trailing exit or whatever, or their decision making is not as because the way I look at it is when you take a trade, when you're looking at the charts and you're neutral, you don't have an open position. You look at the chart and you decide, is there anything going on here? If you say yeah, you take a trade. Now you've immediately gone from neutral observer, right? Let's say you buy the pound. You see the chart. You go, yeah, it's an uptrend. I'm going to buy the pound. So now you should be looking to essentially defend that trade. So it's like if you're playing basketball, when you play basketball, when your team has the ball, you're trying to score. And as soon as you lose the ball and the other team has it, you go straight on to defense. It's the same thing here with trading, where when you're in a trade, now everything has to be about, okay, when do I exit? How do I exit? Is there an exit signal? Instead of thinking, oh, it would be great if this trade would reel off 700 pips over the next 2 weeks, you need to think, okay, where is the exit signal? How do I get out of this? It's all about the defense now. Protect your account. When do you move to break even? When do you take profit? I know it's easy to think that you want it, that you wait long enough, you're going to make those 800 pips, but you also have to be realistic in terms of how many of those 800 pip trades am I going to get each month? And if this is not one of those 800 pip trades, when do I know to get out? And that's really, I think, where the focus needs to be, because I think traders have it opposite. They should have a wider stop, which is, I believe, the way that you trade, with that wider stop and quick to get out. But I don't know. Is that how you trade?
Yeah, initial wider stop, and then not moving the stop up too soon. I think those are the two elements. And when there is a large profit, then you need to be more tighter with your trailing stop. Those three elements, if you can get a combination of them working for you, and you can stick to it over the long run, I think that is the buildings of something with a real edge. And I really think if you get those three right, the importance of the entry becomes much less important, I think. to the point where you can almost take a random trade.
So if I understand you correctly, Darren, you're essentially saying if you boil it down to three important elements for your trading, you believe that if most traders would give themselves a little bit more of a wider stop in the beginning, at least when they first enter the trade, and if they're a little bit more patient when they're moving their stop, so moving to less risk or break even or whatever, you kind of wait for that trade to mature and pull back and then go in your favor. And then finally, when you do have a nice big fat profit on that trade, that you really tighten up your exit and make sure that you don't give it too much room to bounce around and give back too much profit. Is that essentially what you're saying?
Yes, yeah, that's it. I think we basically get those three elements wrong. And if you can get those three elements right, I think that can give you much more scope for different sorts of entries working for you. I understand it's really hard to do. Definitely, those three elements: a wide initial stop, not moving your stop to break even too soon, and then when you get closer to your sort of ballpark take profit figure, whether it be 3-1 or whatever, then you move to a much tighter trailing stop. And if you consider the way that price moves in this kind of up and down zigzaggy wave, then that's a logical way to approach the market.
I often wonder if it's true that most traders have their stops are too tight, which I do believe that's the case from what I've seen. That's kind of a contributing factor with their win rate. The reason why they have such a poor win rate is because they're not giving the market enough room and they're getting stopped out almost from the get-go. Even if they were right, they didn't really give themselves a chance. And then the other thing you say about moving to break even, this is something that I've really kind of struggled with, because I'm okay with the idea that I took a trade that didn't really happen if I get stopped out at break even. So I feel like I moved to break even to try and defend. Like, if let's say I have a target, if the market goes 70% of the way to my target, I will typically move to break even. So it still hasn't reached my target, but I'll defend it, and I don't want it to be a loser now. I feel like I've been right, at least in this instance, and I don't want to be giving money back to the market because I felt, I was too stubborn to leave my stop and let it and decide, we'll see what it is. Is it going to hit my target or is it going to hit my stop? I feel like having that card up my sleeve, being able to use the break-even card is important to me. But sometimes I feel like I do it a little bit too quickly. But what I'm trying to do is, I guess what I'm trying to say is I'm trying to train my mind to think of a break-even trade as a trade that never happened, rather than a winning trade that I lost out on, if that makes any sense. So what do you look for? Do you look for that initial pullback before you move to break-even, or how do you do that?
I'll be honest, moving to break-even is not something that I really use. But as it appears to me that everyone seems to like 1-to-1 risk to reward. This seems to be the most popular level to move to break even. So you're risking 50 pips. When it gets to 50 pips, people seem to like that level as their move to break even. So I would suggest perhaps letting it go a bit further. But you kind of have to look at other elements like trade frequency. If your system only generates 1 or 2 trades a week, then maybe you're better suited to letting more of the trades run. Those other elements need to be taken into account, and I think it's kind of dangerous just to say, well, at 1.5 risk to reward, move to break even, you'll be fine. And I think you kind of need to play with those figures, but just sort of bear in mind that you're never going to find like the perfect. You're going to find something that works. That's all you should really be aiming for, something that works and something that's consistent.
Yeah, absolutely. Yeah. And I think there's a lot of, the reason why there's a lot of wiggle room here is because everyone's different. For most people, the most painful trade to deal with is the amazing winner that they missed out on. and then the other one that's really painful, and I would say can be perhaps more painful, is that amazing loser that you kept adding to or kept moving the stop or made it into a huge loser. Those two things that you have to deal with are really difficult as traders, which is getting a huge loss and missing out on a huge win. Those two are just terrible, right? So based on those, so you have to decide what's like. To me, it's more important to me if I have a trade where I'm in a trade and the market's gone in my favor. I would say substantially if it's gone 70% of the way to my target. It's more important for me to defend my account and not lose money at this point than for me to click out and take the 70% or ensure that I have some profit here. It's more, I want to keep the target where it is because it was set there for a reason in terms of, making sure that I'm not taking my profits too quickly, which is the real killer, right? So that's to me, that's the important thing is I just want to defend the account. Let's not bleed any money here if we can. And other traders are not going to look at it like that. They're going to say, like, for example, maybe you have a really wide 120 pip stop and the market goes 60, 70% of the way to your target, and you take that 120 pip stop and you move it to 60 pips. That's another thing you can do. So you've reduced the risk in half, even though you're not at break even. So you're still giving it some room. Those are the sorts of things that make sense to me. It just depends on what's the most important thing to you as a trader, I suppose.
I like that as well. And, I like it because you'll find most people not doing that, one-to-one risk to reward. Most people are moving to break even. So I'd say, okay, well, let's have a look at just taking half the risk off. Let's look at that. Let's just try and be slightly different. Let's try and be contrarian to what everybody's doing. And I think those are little areas where you're going to find something that's going to start your trading clicking for you.
Yeah. And you can also look at that style of stop management when you add to winners too. So that's something for listeners to test. If you've got this idea that we've just talked about, which is, instead of moving straight to break even, either all or none, there's percentages too that you can manage. Those interplay with adding to winners and things like that, so that you can maintain a risk level that's acceptable and still have the potential profit if it keeps going in your favor. So those are lots of, I think, fruitful areas for research for people who are into this stuff. So I guess we haven't really solved the mystery of the universe, Darren. Why trading's so difficult?
What I would say as well, going back to the original point or question of the podcast, was I imagine a lot of the traders who feel that price is always going against them, it's probably only going against them 50% of the time, but that feels like all of the time. I think, again, you've got to be really clear on your data and journaling, so you can really work out what exactly is going on. Where am I losing money? Which things are working for me and which are not. And our assumptions are more often than not really way off on this. And no matter how smart you think you are, I think you really can't see the wood for the trees sometimes unless you start making notes and planning out and working out what exactly is going on.
That's good stuff. I hope that you guys are able, we've given you a few tools here. There's different ways of managing your stops and your exits. You can see what the crowd is doing, what the retail traders are doing. I'll put those links in the show notes. And you can manage your trades in a different way to the way that everyone else is doing. And that might actually help you. So I feel like it's also so unnatural trading, Darren. Like, it's such a thing that it's just not something that makes sense to most people. I think we tend to kind of, and I don't really want to say follow the crowd, because I don't really think it's following the crowd so much as, everyone's sort of wired a certain way, and that comes through in the market, It's infuriating as well, isn't it? Because it doesn't really go away. You kind of have this belief that, when I get there, it'll be brilliant, because kind of all these doubts and, feelings, and it's annoying trading. And, you can never really, me personally, that never really goes away. And, I think that's why we find it so difficult. It's not natural. Absolutely. Yeah, it's not natural. It's not natural. You've got to sort of teach yourself to do it in a way that's unnatural, essentially. Yeah, that's right. All right. Well, thanks, Darren, and look forward to seeing you next time. Thanks for your time. Thanks, Walter. Cheerio.